The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Now, we've looked at retracement levels, we've looked at projections. We're now going to illustrate how we can apply Fibonacci time projections. Fibonacci time projections establish important technical dates in the future. These are known as TGDs or time goal days. We are not predicting a high or a low in price, or rather, we are not predicting a specific price level, be it a high or a low. The time goal day projection corresponds to a price high, and if this does, then it implies the level is a sell. So to explain what we mean by that particular point, because we are not predicting a high or a low, we're predicting a date in the future. What we do when we are calculating our Fibonacci time projections is we need to identify either two lows or two highs, as opposed to the swing type structure that we had looked at with respect to projections. So if we look at this particular instance, we identify this low over here and this low over here. What we do is we calculate the time distance between these 2 points and project it forward by using, for example, a 1.618 ratio. That gives us an important future date. If at that future date price has been moving higher, as in this instance, then that high represents a potential sell. So we would obviously not just automatically sell because it's arrived at that point. We would look for any signs that reinforce a view that this market should be sold at these levels. If, on the other hand, the time goal day projection represents a trend low, or prices have been moving in a downward direction, then that price, when it intersects with the time goal day, represents a potential buy. These are the 4 possibilities that you have in terms of calculating your time goal days. And remember, the important element is to identify 2 lows or 2 highs. So in this particular example, we're using this low, calculating the distance in terms of days. Let's just focus our attention on days, and then projecting a time goal day forward. Over here, we are calculating that high and that high on that particular swing and projecting the time goal day forward in terms of the calculation. In both these instances, once price arrives at the time goal day, markets have been moving in an upward direction. So these 2 highs represent potential sells. In this instance, we take this particular high over here and this high over here to calculate our time goal day. Here we are taking a low and a low, and we are projecting the time goal day forward. In these 2 illustrations, markets have been moving in a downward direction by the time they arrive at the time goal day. Therefore, these 2 lows represent potential buying opportunities in the market. And those would be your 4 scenarios that you would imply when using time goal days. Let's take a look at an illustration. We come back to the chart that we looked at previously. You will recall with this chart, we calculated 2 swing projections, firstly based on this move, which gave us a projection up here. We then used this swing to calculate a price projection to this particular level over here. Now let's see how we can calculate time goal days based on the swings that we have. So we will look at the swing C, D, and through to E. What we then need to do is we need to identify the two lows, both C and E, and calculate the distance between these two levels in days. This is a daily chart. It marks 74 days. We then take 74 days and we multiply it by 1.618, which calculates to 120 days. We then calculate forward from point E 120 days, and we get our time goal day projection with the vertical line that you see on the chart in front of you. And you can see at what point price action intersects that time goal day over here. So to recap, we take the low at C and E, we calculate the distance in days, it's 74, multiply 74 by 1.618, project the total 120 days from point E, and it gives us our 1.618 projection. When you've calculated that time goal day, you basically have that piece of information that will tell you at some point in the future, once price arrives at that particular point, that would be an important time intersection with price. If price has been moving higher, as in this particular instance, then that represents a potential sell. If price has been moving down, once it intersects with that time goal day, it represents a potential buy. In this instance, we can see that prices have been moving higher. What is interesting as well then is that the time goal day and price intersection also corresponds with the level we had calculated earlier by the swing from C to D and calculating a 1.618 projection. That then reinforces the technical importance of that particular date and the price level that price is currently trading at. Remember that if a number of applications converge on the same price level, it reinforces the overall significance of that level as either a resistance, or certainly if price breaks above it, the importance of that level. So in this case, we have a situation where both price projection and time projection coincide. The date and therefore the price level are very significant. We saw earlier in terms of the discussion that, and we can see again what occurs is that some form of resistance develops, but only actually leads to a correction. And once we start to break higher above this level, that further reinforces the significance of the current uptrend. So we've looked at retracement levels, we've looked at projections, we've looked at time goal days, and we can see that on occasion, the application of these three approaches using the ratios that we've now become familiar with can also lead to an important amount of information relative to what is important on the chart, both from a price perspective and a time perspective. That then concludes our focus on the retracement levels. We will now move our attention to discussing the Elliott wave principle. In our discussion, we will consider the five-wave pattern. Very important that you understand what we mean by the five-wave pattern. We'll look at the impulsive wave, the corrective wave, what we mean by wave repetition, and that will give you an understanding of the concepts that we need to be aware of when applying the wave structure. Now, at this stage, I think it's important for me to stress that the subject of Elliott wave is regarded as one of the advanced topics in technical analysis, and it is a pretty broad subject. Unfortunately, for the purposes of this webinar, we don't have enough time to go through all the intricacies around the wave structure. So the purpose is simply just to introduce you to the concept of the Elliott wave structure. There is enough literature that can be found either on the internet or in terms of books that have been written, should this approach be something that you'd like to explore further. It is a very powerful technique in terms of being able to analyze trends, and would be something that we'd recommend you at least consider looking into to have a much broader understanding as to how you can apply the Elliott wave process. Now, we need to understand the basic five-wave structure. And the basic five-wave structure works in the current form. Any major movement will unfold in a pattern of 5 waves, which in turn will then be corrected by a pattern of 3 waves going in the opposite direction. The 5-wave movement can be split into 2 distinct segments. The impulse. We'll start with the impulse initially. Now, if we go back to the earlier statement, any trend or any market movement that is in the direction of the trend will break down in a 5-wave sequence. What we mean by wave repetition is that this is the only wave pattern relationship that exists in the market when applying the Elliott wave approach. We will never discuss 9 waves, 6 waves, 2 waves. It will simply be a 5-wave structure, and this is what you need to identify when evaluating price action. What is the impulse? The impulse is known as the trend phase. In other words, it is the direction the market is trading in when it is moving in line with the current dominant trend. So in the illustration that you have in front of you on the left, because the impulse is moving in an upward direction, this is known as the trend phase. In other words, the primary direction is up. Anything that moves in an opposite direction to that, which we'll see very shortly, is known as the correction. In terms of identifying an impulse, it is also known as the numbered phase because it is labeled 1 through to 5. It's important to also appreciate that when we are looking at one impulse, in this instance what we mean is that we have one complete impulse from this point over here through to wave 5 up here, is that an impulse is itself constructed as a series of 5 individual waves, 1, 2, 3, 4, 5, which means that waves 1, waves 3, and waves 5 are also regarded as impulsive waves because they are moving in the direction of the trend. Now these would be referred to as impulsive segments 1 degree lower. In other words, think about it in the way that you are looking at the move from 1 to 5 under a microscope, and then you can identify these 5 swings. So 1 degree lower, wave 1, wave 3, and wave 5 will also be regarded as impulsive waves. If we look at the impulsive segment in a little bit more detail, and we take the component that we were looking at in the previous slide and zoom into that activity, it then also makes sense because of the repetitive nature of the wave structure that each impulsive wave that makes up this one impulsive wave will in turn also then break down into a 5-wave structure. So wave 1 breaks down into a 5-wave structure. Wave 3 itself breaks down into a 5-wave structure. And wave 5, the final leg up, also breaks down into a 5-wave structure. So any move that represents a move in the direction of the primary trend is known as an impulse, and that move will break down into a 5-wave structure. Very important that you can get to grips with this logic. And also remember that this is the only pattern structure or wave pattern structure that we are looking at when it comes to the Elliott wave principle. Any move that moves in an opposite direction to the impulse is known as a correction. And remember, the trends move through a series of peaks and troughs. So they will move if the trend is up, they'll move up for a period of time, and then they will pull back and move in a downward direction. That downward direction against the primary trend is known as the correction. It is also known as the lettered phase. because it is labeled A, B to C, and because it is only made up of 3 waves. So if you think of it in using another analogy, if we were to move forward and we were pulling back every so often, if we take 2 steps forward, 1 step back, 2 steps forward, 1 step back, we will still continue to move in a forward direction overall. That is the same logic with the Elliott wave principle in terms of looking at the progress of a trend over time. It's made up of 5 waves during the impulsive phase and 3 waves during the corrective phase. It also makes sense that this 3-wave correction will not extend beyond the start point of the last impulsive wave, because that would then not result in a structure where prices are moving in an upward direction. So if we were to take, for example, this move to that move, and then down there, that can then also be broken down into its own 5-wave impulse and a 3-wave correction before the market starts to move higher. And this is the pattern structure that we are looking at and employing when we apply this particular approach. It's also important to remember that just as one impulse, 1 through to 5, is made up of 3 impulsive waves, it then, in order to complete the overall structure, is made up of 2 corrective waves, wave 2 and wave 4. So wave 2 corrects wave 1, and wave 4 corrects wave 3. Once we've completed 1 through to 5, A, B, and C will correct waves 1 through to 5. And because a correction breaks down into 3 waves, it's also important to remember that wave 2 will itself break down into 3 waves, as will wave 4 before completing that corrective move. So that is the repetitive wave structure in terms of the pattern that we are looking for and applying when we use this methodology. That then brings us to the complete wave structure, where we looked at the initial illustration by highlighting wave 1, wave 2, wave 3, wave 4, and then wave 5, which completes this one broader impulse. If we then go 1 degree lower, we can see that we have 5 waves that make up each impulse. In other words, the impulses are wave 1, wave 3, and wave 5. We also have 2 corrective waves, wave 2 and wave 4, and these break down into, there should be a C there, break down into a 3-wave structure. And that will then complete wave 2 before the uptrend resumes. So if you can develop skills whereby you understand how to evaluate the various wave structures, and then you can correctly identify, for example, the end of wave C down at this point, or the end of wave C down at this point to conclude the 3-wave correction lower, then you potentially are able to identify the levels at which long positions should be established in the direction of the trend. If you're able to effectively identify the top of wave 5 at this point in time, then you would correctly raise the question, it is unlikely that price action would move or to move in an upward direction, and we are likely to see a much broader pullback in price action. That would then provide you with some evaluation as to what to do with a long position. Let's assume you're in the fortunate position of being long down at this level, or whether you actually would prefer to even establish short positions as the market corrects in a downward fashion. So it is a very powerful tool in terms of allowing us to gain information and enhance our understanding of where price action is or where the trend is relative to where it has come from. Let's take a look at an example over here. You can see we have quite a vast amount of price action, and our focus of attention will be on the move from this low over here up to this high over here, which clearly represents a primary uptrend in price action. First and foremost, we need to identify the two major turning points that we'll be looking at. And you can see the key swing points that have been identified: 1, 2, 3, 4, and 5, to highlight a completed 5-wave sequence. Now, certainly this doesn't look as neat as a illustrated drawing of a trend, but remember, what you essentially are looking to identify is a complete 5-wave structure from your start point to the end point. If we can just simply take price somewhere along the lines of what we've identified, we can clearly see that there is a 5-wave structure in price action over there. Now remember that we have impulse 1, impulse wave 3, and impulse wave 5. If we look, for example, at activity in wave 3, you can clearly see that we can identify wave 1, wave 2, wave 3, wave 4, and wave 5. Notice too that even if we then look at wave 3, we can identify a turning point there. The turning point there is that 1, 2, 3, 4, and then 5 completes wave 3. So the pattern continues to repeat itself. What is important for you as an analyst is to be able to be aware of what is the current dominant direction in trend. If we take a look at the move from 3 to 4 over here, you can clearly see that because it is a correction as part of the impulse between 2 and 3, that it then by and in of itself will then break down into a 3-wave structure, A, B, and C. And that is how we can apply the Elliott wave structure in terms of identifying where the current broader trend is. You can appreciate that by being able to effectively identify perhaps the end of wave 4 down here, you have the opportunity to trade a long position. If you're able to identify or come to conclusions that there is a strong likelihood this is wave 5, then you're getting early insight in terms of drawing conclusions around whether market sentiment can continue to move in an upward direction, or are we likely to see downward pressure in price action. Very powerful tool, as I mentioned earlier, in terms of assessing conditions with respect to the trend. Let's look at how we can further enhance our evaluation of the market by applying indicators as a confirmation tool. What you see in front of you is a key downtrend that has been labeled, if we just look at the primary labeling in black, 1, 2, 3, 4, 5. You can clearly see, and this is simply for your reference points, that we have a internal count on 2 to 3, labeled 1, 2, 3, 4, and 5. And even if we look at the move from 2 to 3, that in and of itself breaks down into a 5-wave structure. So do not deviate from the 5-wave impulse and the 3-wave correction. Now, what we can see at this stage over here is that price action has moved in an upward direction. This perhaps lends some additional weight to the fact that we may have indeed completed an important 5-wave sequence as highlighted in the labeling in front of you. If that is the case, then that tells us that we should see 3 waves, A, B, and C. And if you have an understanding of that, then you might come to the conclusion that, okay, we're currently at this point in time. Is the market likely to move higher? And if so, does this represent an opportunity to buy? So let's summarize in terms of what we've been able to identify. We potentially have a 5-wave bearish structure that is complete. The market has rebounded off what appears to be the end, potential end of wave 5. If this is the first rebound of the end of that 5-wave move down, then this first section is potentially wave A of a correction. And if that is correct, then we potentially have 2 more waves, B and C, to complete the broader correction. Let's perhaps consider momentum indicators and see whether this tells us or provides any additional information. And we can see that by just simply applying a relative strength index and a 14-period relative strength index, we observe a condition that we became familiar with last week. In other words, we have bullish divergence between price and momentum. Just to remind you what this is, price action is moving in a downward direction still. We just simply look at that low versus that low. However, price action continues to move in an upward, or rather the momentum indicator has instead established a more uptrending structure. In other words, the momentum oscillator is suggesting that there is potentially inherent weakness in this downtrend, which would make sense if we're approaching the end of the wave structure. In other words, if you look at it from the phase of a trend, this could be seen as phase 1, 2 to 3 as phase 2, and this final area over here as phase 3. So the trend is becoming technically weak, potentially technically weak, according to the bullish divergence that exists between momentum and price action. Now, when you are applying the Elliott wave process, the fact that you have divergence between price and momentum is a classic setup as the wave structure approaches and enters the 5th wave. So in this instance, because the market has been moving down, bullish divergence is a classic setup of this current decline. It adds confirmation to the count. It provides additional trading information. If a recent rebound in wave A, then wave B down will likely unfold. We'll then likely see that a wave C will follow. In other words, we can consider to buy the dip in the market and trade a long position around wave C. This illustrates how we could use the Elliott wave process as a trading tool and further reinforce the readings that we make by the use of momentum oscillators. In today's webinar, we introduced you to the Fibonacci number series. We tried to answer the question, what are we really trying to do? We looked at retracements, projections, and time projections. We then went on to introduce you to the Elliott wave principle, the basic 5-wave structure, the impulse, the correction, as well as the complete wave structure. We finally ended the webinar by showing you how we can apply indicators as a confirmation tool. That concludes today's webinar. In tomorrow's webinar, we will be looking at understanding price ranges. We'll be showing you how you can effectively manage price ranges, understand breakout trading, look to trading a range. We will look at the concept of order flow and the questions that you need to ask with respect to order flow. Finally, we will look at what price confirmation is all about. Congratulations, everybody. You've now finished webinar 10 of the Advanced Technical Analysis course. Thank you very much for joining us. This has been a focus on Fibonacci and Elliott wave, and we look forward to seeing you next time. Bye for now.